Hi everyone. I wanted to work through some problems in Chapter 10. I'm going to be typing out the answers, working on typing instead of writing. I know sometimes my handwriting can be a little messy and harder to read, so I figured typing would make things easier. So I am going to start with problem P1076A. This is on page 581 of the textbook. Okay, so looking on, sorry, this is on page 579 of the textbook. So looking at on this problem, chapter 10 is a little bit of going deeper into journal entries that we've already done before. Now we have some other things like par value and other issues that come up. So we're just going to do some journal entries, and we're going to show what just our stockholders' equity section of the balance sheet looks like at the end of this period. So in this case, we have just 3 journal entries. The first one is January 6th. They don't give us the year. Some common shares are issued. 900 shares of common stock are issued for somebody to do some work for the company. The fee to do this promotion was $27,000. We're going to debit, they tell us to debit an account organization expense. So I know I'm going to debit organization expense for $27,000. I'm going to credit common stock for $13,500, right? Why 13,500? Well, it's 900 shares times $15 par. And the remainder is going to go to paid in capital in excess of par. Oh. Here we go. So that's the first journal entry. Then we have January 9th. We're issuing 4,000 shares of common stock in return for cash. So just getting cash for it. Okay. So we're doing a total of 18,000 shares, 4,000 plus 14,000 shares, $20 value per share. So how much cash are we getting? So this was January 9th. So we're getting cash in the amount of $360,000, right? That's just $20 per share times 18,000 shares. Then we're going to credit the common stock that we issue. And so this is going to be a total of $270,000, right? And that's just the math of $15 par times the 18,000 shares issued. And the rest is going to go into, I'm just going to now call it paid in capital in, I'm going to do, you know what I'm going to call it? Additional paid in capital. Just understand that this is the same thing as this, okay? Just to keep things for the rest of these problems easy, I'm just going to call this additional paid in capital, okay? But the textbook might say paid in capital in excess of par. Same thing, okay? So again, same thing, these two accounts. I'm just trying to save from typing too much. And so this is just going to be the difference, which is $90,000. Right. Then we have January 26th. We issue 1,600 shares of stock for $25 cash per share. So another very straightforward transaction. So how much cash are we getting? 1,600 times $25 is equal to 40,000. And common stock is going to be, again, $15 times 1,600 shares, which is 24,000. Whoops. Nope, 24,000. And additional paid in capital is going to be the remainder, which is 16,000. Okay, so hopefully that makes sense on the journal entries. Now let's scroll down and do the stockholders' equity. So this is from the balance sheet. This is just part of the balance sheet. So stockholders' equity at whatever the end of the period is. So this is, you know, whatever Jefferson Rafts Inc. Balance sheet, March 31st, 2019. And I'm skipping the assets and liabilities and going straight to stockholders' equity. What items am I going to have under there? Well, I'm going to have the common stock, and that is going to be 20,500 shares that are issued and outstanding times $15 par, and that should equal here $307,500. Then I'm going to have that additional paid in capital or paid in capital in excess of par. So let me actually call it that. Here, let me fix these so people don't get confused. There we go. There we go. Okay. For common, this is a common stock. So again, if I add that up from up above, I get 119,500. So here my total paid in capital is the sum of those two. If I add those two up, I get 427,000, right? That's just the sum of these. That is what I call my total paid in capital. Then I also have retained earnings, right? That's part of stockholders' equity. And they tell me retained earnings is 55,000. And so my total stockholders, actually this should really be like this, equity equals 482,000. Okay, so that is the final answer. Okay, let's work on another problem. Okay, this is going to be P1079A on page 581. So go ahead and take a look. Again, they give you the balance sheet for December 31st, 2018. In 2019, they give us a bunch of transactions. They want us to journalize these transactions and then prepare the stockholders' equity section, okay? And they give us some information here that net income for 2019 was $23,000. So first things first, let's do a bunch of journal entries. So I'm going to go through these fairly quickly because some of them should be repeat, at least the logic is repeat from the previous problem, and some of this is repeat from earlier chapters. If for whatever reason the journal entry doesn't make sense or confuses you, please send me an email or come to my office hours and we can talk through it. But I'm going to be just going through these pretty quickly here. So 213. Issued 5,400 shares of common stock at $9 per share. So that means I got cash of 48,600. I issued common stock at par of 32,400, right? Again, just as a reminder, $6 par times 5,400 shares. And the remainder is going to go into paid in capital in excess of par, common stock, right? I'm going to call this APIC, okay? So going forward in the journal entries, I'm just going to put APIC instead of all of this wording. So that's just going to be the difference, and that is going to be 16,200. Next journal entry, March 19th, sorry, June 7th. I was looking at the wrong box. June 7th, declare regular cash dividend on preferred stock. So let's look up at the preferred stock. The preferred stock is 70 cents, and we have 800 shares. So that's our preferred dividend is going to be, so we have to reduce our retained earnings by the dividend amount. And what amount is a dividend amount? Well, it's 800 preferred shares times 70 cents per share. So we're going to reduce retained earnings by $560. We're going to create a liability, dividends payable, because we declared them, for $560. June 24th, we actually pay this dividend. So when we pay it, all we're going to do is reduce our dividends payable liability by $560, and we pay cash $560. Okay, August 9th. We declare and distribute a 20% stock dividend on common stock. The market price of the common stock was $12 per share. Okay, so another dividend. So we're going to reduce our retained earnings by what amount? Well, it's going to be the shares that we have outstanding, right? Which at this point we look and see that we have 6,700 shares from the balance sheet December 31st, 2018. I'm just looking at the in the book at the green box on top. Then on February 13th, we issued another 5,400 shares. So that gives us 12,100 shares that are out there. It's a 20% dividend, and the market price is $12 a share. So how much of a dividend have I declared? $29,040 is the dollar value of that dividend. And again, I'm going to issue, in this case, I'm issuing stocks. I'm issuing common stock. So how much am I going to credit common stock for? Well, how many shares am I issuing? The shares I have outstanding, I'm doing 20% of a dividend, and the par value of each share is $6. So if I do that, I get 14,520, and the extra is just going to go into additional paid-in capital, which in this case is actually the same, works out to the same amount, right? The math works out to the same, because remember, our credits have to equal our debits. Okay. October 26th. We buy back 600 shares of common stock as treasury stock. We pay $14 per share. So we're going to increase our treasury stock account, 600 shares times $14 per share. That gives us 8,400. And we are paying cash of 8,400. So that was buying some treasury stock. November 20th, we sold 300 shares of treasury stock for $18 per share. So we sold it for more than we bought it for. Okay, so we're going to receive, obviously, cash. We sold treasury stock, so we're going to get cash. We sold 300 shares at $18 a share. So that's going to give us $5,400. Okay, we have to reduce our treasury stock. Okay, because remember, we created this treasury stock account up here. We're going to reduce the treasury stock account by the 300 shares, and that was the $14 that we paid before. So we're reducing that account by 4,200. And when you do transactions in your own stock, company stock, as you remember from the lecture in the book, it's not a gain. It's not like you made money. It would be kind of weird to say you made money. Well, instead, what we call this is paid in capital from treasury stock, or treasury stock transactions is how the book may call it. So that's going to be the difference, which is 1,200. Okay, so we debited cash, we credited treasury stock, and paid in capital from stock transactions. And then December 31st, we're going to declare a cash dividend of 25 cents per share on the outstanding common stock. Dividends will be paid in January. So we know this is going to be dividends payable. So December 31st, we're going to hit retained earnings. By what amount? How many shares do we have outstanding now? Well, we started with 6,700 at the very beginning. We issued another 5,400 back on February 13th. Then on August 9th, we did a 20% stock dividend, right? And 20% of 12,100. So then we have to do 20% of 12,100. So all of that equals 14,520 shares. So 14,520 shares less 300 shares. So let me do that first. So that equals 14,520 shares less the 300 that we still have in treasury stock. So now we have 14,220 shares. Now we have to pay a dividend of 25 cents per share on. See all that math? So retained earnings is going to get hit by what amount? So I'm going to get rid of this, but that's the math. So retained earnings is going to get hit by $3,555. So where did I get that number? From all that math I just did. And then they say we haven't paid it yet, so this is a liability, dividends payable, $3,500. So again, how does the stockholders' equity section look? So the stockholders' equity section is going to have a couple different things here. Here we have the preferred stock. So we have the 70-cent cumulative preferred stock. How much is issued and outstanding? 4,000. I'm just copying that up from the information they gave us in the old balance sheet. Common stock. So how many shares are issued and outstanding? Well, we just did that math. 14,220 shares times $6 par. So that should equal 87,120. Then we have paid in capital in excess of par for common stock. And so if you just go back and add up some of the dollar amounts, we started with, I'm going to go here to do this calculation. So back on the balance sheet from the previous year, we started with 18,500. Okay. We issued on February 13th another 16,200. And then we issued on August 9th another 14,520. So that should all equal up to 49,220. And then last but not least, we also have our paid in capital in excess of par. Actually, no. In this case, we have paid in capital from treasury stock transactions. So that's going to be 1,200. And that's all of our paid in capital. So if I add all this up, our paid in capital, so total paid in capital is 141,540. And that's just totaling up those previous four numbers here. Then we have our retained earnings. So what am I going to have for retained earnings? Well, I'm going to have the number I started with back in December 31st, 2018 that they gave me, 22,000. They told me my net income for 2019 was $23,000, so I'm going to add that to retained earnings. Then I paid some dividends. I have to, all the areas where I debited my retained earnings, now I have to adjust that. So go back to the journal entries if you don't know where these numbers are coming from. So my retained earnings here comes to $11,845. And then I have my treasury stock, which remember is a contra stockholders' equity account. That means it's going to reduce my stockholders' equity. I have 4,200 still remaining of treasury stock. So my total stockholders' equity, when I add all this stuff up, is 149,185. Okay, so that's the final big picture number. So you should be able to calculate that total stockholders' equity amount. So go back and figure out if for whatever reason it doesn't calculate or it doesn't work for you, figure out why it doesn't work in this case. Okay, so those are the main problems that I wanted to work out with you. So please give those a try. And if you have any questions, feel free to shoot me a message and we can work through it.